Hello everybody, welcome to Pileinvesting channel. We bring the best study and research related to personal finance, capital growth, best practices of investing, and strategies for normal investors. This is the second video of the Simplify Investing playlist series. In this video, we'll be going through and discussing the basic concept of economics. Let's dive into the world of economics. Investing is the process of growing your money. That is only possible if the assets you purchase increase in value and generate profits. The most basic economic principle is that the economy can only expand if customers spend money. Otherwise, it cannot. A strong economy leads to increased consumer spending, corporate success, and investment growth. The majority of the nation's GDP, or gross domestic product, actually comes from consumer spending, which powers the economy. An investor's chances of success increase when they keep an eye on the economy and take advantage of future developments. Profitable investing is all about future growth. So while everyone else is focused on what is occurring now, successful investors can concentrate on what's coming next. The first topic is buying and selling. There are many subheadings under this one, and we'll go through each of them as well. Let's discuss about basic concept of economics. I divided this video into two parts. Part 1, principles of economy along with demand and supply, and Part 2, Fed and interest rates. Let's dive into Part 1, vital principles of economy. Considering that there are more than 7.5 billion people on the planet, social connections are abundant in our world. People buy, sell, manufacture, and consume commodities and services, among other economic activities. These exchanges take place inside the complex framework of economics, which makes it easier to distribute the goods and resources necessary for survival. This economic system ensures that people in many locations and communities can obtain the basics of life through the production, trade, and consumption of products and services. When thinking about investing your money, you usually don't need to be an expert on how the economy functions or its lesser-known facets, but it can help to have a basic awareness of a few important concepts. Understanding ideas like supply and demand, how companies make money, and how economic events affect investments is crucial. You may potentially improve your chances of financial success by making better investment decisions by understanding these principles. Value and price. Products have worth because they fulfill a need, and people purchase and sell things because of this value. A product's price tag, for instance, indicates its economic value, but its overall value is also influenced by its usefulness or functionality. By considering both the financial value and the potential benefits of using products and services, people can make more informed judgments when making purchases by having a better understanding of this dual aspect of value. Value is a dynamic term that can change throughout time. Sometimes the value of an object decreases quickly. For instance, you may have noticed that there haven't been any significant rises in petrol prices recently. This phenomenon can be partially explained by consumers choosing more fuel-efficient cars or alternate ways of transportation, which lead to lower petrol consumption. As a result of decreased demand, the market sees a drop in the price of petrol. Like many other commodities, the price of petrol is determined by supply and demand. The price of petrol tends to drop as supply outpaces demand. On the other hand, when demand outpaces supply, prices typically rise. Income. Income is the amount of money you get to meet your fundamental requirements and wants. It can come from a variety of sources, including investments, gifts, inheritances, and money you make at work. Understanding your sources of income is essential since it gives you the ability to properly manage your money and live within your means. Knowing your sources of income will help you plan your spending, save money, and keep your finances stable by preventing you from going over your income cap. Your income might be greatly affected by life changes. Retirement from one or more occupations is one of the biggest life adjustments. The income you are used to receiving is frequently significantly reduced when you retire, so you will need to discover other sources of income to replace or augment it. It's essential to prepare ahead of time for this change to guarantee financial security during your retirement years. You may better manage your money and have a stress-free, pleasant retirement by planning for the inevitable financial adjustments that come with getting older. Consumption: the money you and your family use to purchase things and services, such as groceries, clothing, utilities, and entertainment. Basically, whatever you spend money on or consume is referred to as consumption money. It's essential to closely monitor eating patterns. Financial difficulties may arise if you observe that while your expenses are rising, your income is either declining or stays the same. On the flip side, if your spending remains relatively stable and aligns with your income, it indicates that you are likely managing your finances effectively. Maintaining a consistent level of spending that corresponds with your earnings is a key indicator of financial responsibility. This practice helps in achieving financial equilibrium and mitigating the risk of unnecessary debt or financial hardship. By staying vigilant about your consumption habits and making necessary adjustments when needed, you can sustain a healthy financial situation and work towards long-term financial goals with confidence. Saving and investment. Lastly, let's talk about what families should and shouldn't do. Save and invest. A major asset for individuals used to be their savings. In the 1960s, it was typical for people to set aside 6 to 10% of their income for savings. But in the 1990s, this trend started to decrease, and for many people, it has since reached almost negative levels. It's not ideal to depend entirely on your paycheck to pay for bills, but a lot of people find it difficult to save more money or locate other sources of income. This underlines how important investments are in the current financial environment. It is enough to only set aside a percentage of your income. You also need to look for ways to invest that money and get profits. Through investing, you can gradually increase your money and ensure a more solid future. Before proceeding, I have a small request. Please take a moment to like Pileinvesting videos and subscribe to our channel. Your engagement plays a vital role in our ability to continue delivering. Please do support the channel if you all find the content helpful. Part 2. This part describes the Fed and interest rates. Fed. What is the Fed? The Federal Reserve System, established in 1913, manages interest rates, U.S. monetary policy, supervises banks, and serves as a financial servicer for the U.S. government and lending institutions. The Federal Reserve has the authority to control the federal funds rate, which sets the standard for all other interest rates charged by Federal Reserve banks. Interest rates. The costs that borrowers of money pay to lenders are known as interest rates. Interest rates have an impact on all types of investments, although to varying degrees, including stocks, bonds, and real estate. You need to first understand how interest rates operate to comprehend that influence. For the majority of us, interest is just something we accrue on our savings accounts, or, more frequently, an additional amount of money we must pay with credit card companies. It's a strange number associated with financing costs for some people. That is the level to which interest rates directly affect our lives, and that is where it ends for us. Higher interest rates for individuals and businesses might be problematic for investors because it can mean less money available for expenditure. As a result, changes in the federal funds rate can affect company profitability and consumer spending, which can indirectly affect the financial markets. It has little direct impact on the markets themselves, though. Companies may not have as much money available for dividend payments and future expansion plans when rising interest rates result in greater borrowing expenses. This may have an impact on the total amount of money available for investments and restrict market growth and profit possibilities. Lowering Fed interest rates boosts the money supply, attracting investors to buy stocks and aiding economic expansion, leading to corporate growth and increased share value. Thank you for watching the Simplify Investing playlist video number 2. We appreciate your support. If you found this video helpful, please consider liking, subscribing, and sharing it with others who might benefit. Stay tuned. See you in video number 3 of the Simplify Investing playlist. Thank you.